Welcome back everybody for another video here from the Concrete Jungle. Today is Saturday, June 18th, 2022. Welcome. Thought I would just run through some charts here amid some significant market volatility, particularly in the crypto sector, where we can see clearly blood-filled and shark-infested streets. So we're going to use, the principles of classical charting to try to cut through some of the noise, cut through the emotion, the fear, the liquidations, the narratives, the very, very depressing narratives that we're kind of seeing. People who were formerly up only and refusing to admit that we were in a bear market, now coming out of the woodworks and sort of latching on to the liquidation narrative and the Fed hawkishness and this time is different and etc. So again, anytime it gets a little confusing for me, start getting caught up in the emotions. It's nice to be able to step back and just look at what the price is telling us, and try to manage our risk, as best we can. So let's get into the charts. I thought I would try a little different format now that I've sort of gone through some basics about chart patterns and measured moves and moving averages, that instead of drawing them out individually, to sort of just show you my thoughts a little, and hopefully it'll be a little quicker with each chart. So I've described this pattern that I'm seeing here on Bitcoin as essentially what amounts to a double top. So it bounced to range between these trend lines for some time, failed to make it to the top of the range, and of course broke down, and this time decided to take a couple of different measured move targets just to get an idea of a potential range for where this projection may end up, and kind of arrived at a range of basically around 16 to 16,500. Now, strictly speaking, this is sort of a minimum target, if you will. Once the pattern breaks down, the sort of technical minimum target would be in that range. So it doesn't necessarily amount to a macro bottom, but really just describes the minimum projection in relation to the pattern that we've described. So seeing a lot of talk about the 200-week moving average. Yes, it has served as important support for many, many years, and it may very well be the case this time. But I think it's a little early to be calling things like that. But I do think that and of course it's nothing on this channel or in this video is financial advice. But I do think that the risk of 18,000 Bitcoin, certainly compared to 69,000, is more favorable. So let's see how that turns up. So Bitcoin dominance pulling back a bit from the top of this sort of what looks like a bit of a rectangle. Still long-term downtrend. In the dominance, the 200-week moving average has sort of flattened out, while the dominance has ranged. Seeing some different theories as for the pullback. Potentially a increase in stablecoin market cap relative to even BTC and certainly ETH and altcoins, amid a slew of what appears to be institutional and hedge fund VC liquidations or impending liquidations. And so, the thesis of sort of an increase in the dominance, I think, still makes sense. That just from the stance of being in a bear market and altcoins generally underperforming against Bitcoin, and altcoins being sold into Bitcoin, and Bitcoin dominance going up, I think still makes sense. Although it does look like we're in a bit of a range here, kind of seeing which way it'll break out of this rectangle. But the sort of my prior idea of a triangle and a breakout is still possible. That this sort of is just retesting the bottom, the top of this triangle before resuming up, and a resumption or a breakout above this range, would basically get us up to about 60% Bitcoin dominance. If it were to continue up from here, from this sort of consolidation pattern, which would still represent a lower high relative to the previous peak of 73. So we just sort of need to see how this plays out, and I'd be curious and interested to see how how the dominance shapes up as well. Now, Ethereum, has seen price action essentially mirroring that of Bitcoin, although with greater, greater moves either to the up or the downside, over its history, and we're seeing the sort of downside part of that now in full force. And so again, similar principle with a measured move, sort of trying to get a range of possibilities and a range of price targets, and the price has sort of pierced below this sort of minimum technical target of let's say 920 to 1050, and now is around the 930 mark. So it looks like the technical target for this sort of head and shoulders double top type pattern has fulfilled, and again it is quite a bit below the 200-week moving average, although Ethereum has been known to spend a bit of time below there in its past. So again, kind of just like for Bitcoin, the minimum technical target of where we kind of are now has been fulfilled. Is it a macro bottom? It's really hard to say at this point, one way or the other. Certainly the risk is better than at 5,000, but I think it is a bit like catching a falling knife, at this time, especially for ETH and certainly for altcoins. Ethereum to BTC. So what I have here is sort of the 200-week moving average for Ethereum to BTC, and then of course the trend lines that we've been following. So again, if we take a measured move from this range pattern that had been developing, we're kind of almost there, but not quite. Haven't quite touched the trend line, haven't quite fulfilled the minimum technical target, which would be at about 0.046, 0.045, for the ETH to BTC ratio. So my base case is that there is probably a little bit more room to the downside for Ethereum relative to Bitcoin. And so, again, nothing here is financial advice, but I'm looking to kind of wait and see what Ethereum does. Certainly Ethereum looks to Bitcoin for leadership, certainly in times like these, and either leadership to the downside or the upside. So I think ETH is still relatively more risky compared to Bitcoin, which itself is obviously very risky as well. So let's see how this ETH to Bitcoin chart shapes up. It's a very important chart. I think what I'm seeing a lot more of is, people who have been interested in crypto, either on social media or YouTube, and sort of coming out of the woodworks and saying that, they hadn't really, they sort of looked at crypto in a bubble, in isolation, in a vacuum rather, without considering, the equities market, the stock market, the macro landscape, inflation, etc. And so figured I would give a little color on some of what I think, the charts that I've been following and think are pretty interesting, starting with the S&P 500. And so what I have here is I just had a little fun with these trend lines here. So I have this thick, sort of macro trend line, just connecting the dots from, as early as 1942, and had several touches in the 70s and 80s, then a touch, looks like during the Great Financial Crisis, and it's sort of up and to the right, the S&P 500, and so kind of just thought it was interesting the various trend lines and sort of that have developed, particularly in recent times, recently being sort of since the 80s, but and I thought it was interesting to just give an idea of some potential support and levels. The monthly, sort of hovering right at this shorter term trend line, and is looking to kind of threatening a breakdown. Still have 11 days on this monthly bar, but kind of threatening a breakdown here of this shorter term trend line that we're in. We've already broken several other trend lines as we sort of fall from steeper slope trend lines to more longer slope trend lines as support. So and a bit of a gap as well. So short term, I wouldn't be too surprised to see further continuation to the downside here on the S&P 500 to, let's say, around the 3,000 level, to sort of retest the trend line made by the the Corona crisis from March 2020. Sort of these two dumps, making perhaps for getting ready for a third touch. So let's see how that shapes up in terms of the S&P 500. So the U.S. dollar index, certainly short term, has been showing lots of strength to the upside. Longer term secular trend has been making lower highs and lower lows. But in terms of the intermediate term, it does look like we've formed a bit of a trading range here. Dating back to, let's say, 2015-ish, 2017, and a bit of a look of a double bottom, potential double bottom, which has, again, on the monthly chart, we still have about 12 days on this bar, but, the weekly candle sort of closed above this range, above the previous high of the range, and looking like a potential double bottom. If that were to be the case, the technical target for the U.S. dollar index would be up to 118. Of course, the U.S. dollar index is heavily weighted against the euro, and of course the Japanese yen, and then some others like the Swiss franc, and I think the Canadian dollar is in there as well. But there are two other currencies that are notably absent from that index, which I think is interesting. But certainly the Dixie is one that people like to follow. So, in the basket that's measured by the Dixie, certainly I could see relative. The U.S. dollar doing relatively less bad. Let's put it that way, compared to let's say the euro and the Japanese yen. So there are some correlations of the U.S. dollar when it does well. U.S. risk assets tend not to. So it's quite possible we may be in for some more of that, but we'll see. So the oil chart, this is having a bit of fun with it, but I couldn't help but notice, a bit of a macro triangle and a possible breakout, for crude oil, and I'm not quite sure that this, this may end up making some other pattern. I hope. But I just thought this was interesting. We had sort of this triangle formation, which, more recently failed to make it back to the top of this trend line. And of course, we know what happened, during the March 2020 crisis and how oil went negative, broke way down, and is sort of starting this new uptrend. So, with one geopolitical event after the next, and the policy responses, the ensuing policy responses, they can obviously change very quickly. But I don't know. This is a bit of having some fun, but maybe we would see a bit of a retest and provide some relief for oil prices. But based on what I'm seeing here, oil's got lots of room to the upside, barring some significant pivot in the geopolitical situation and the policy responses. So personally, any sort of retracement back to this trend line, I would view as a very nice opportunity. Again, not financial advice. Gold, pretty interesting. So while risk assets have been sort of in the dumps, S&P 500, the Nasdaq, certainly crypto, gold has been holding up pretty well. More so than the narrative would have you believe. A lot of folks, that you hear are sort of down on gold and how it's only useful as portfolio insurance, and which there's some truth to that. Gold bullion isn't exactly how you get Bitcoin style returns, but in a period of secular inflation and macro uncertainty, it's held up pretty well. And we have sort of this macro cup and handle, and currently consolidating around this sort of the top of the cup, if you will. Had a big spike up to the 2000 level recently, and now coming back to what I think looks to be a bit of an inflection point. So if we kind of zoom into the handle, we're sort of consolidating around this vertex of the triangle, which coincides with the the previous high. And so I'd be very interested to see whether gold could actually form this area as support and move higher. But there's no guarantee that it couldn't keep ranging, within this range for a while, though. So let's see what happens on gold. And finally, the U.S. 10-year Treasury Note Yield. So, I think the case for the bond bulls, they're basically running out of time. Is how I see it, in terms of the sort of the pivot in yields. So I think last video we were looking at around just under 3%, and really showing no sign of, maybe had a slight retracement, but the weekly candle closing above. So I still think that the 10-year yield has quite a bit more room to the upside, about 6%. So, one area I'm looking at increasingly is the housing market. We're already seeing signs of mortgage demand, at multi-year lows in terms of the demand for mortgage demand. So, the effect on housing prices, I think, is a little more nebulous, just given the interplay between supply and demand. But I do think that the cost of financing has more room to the upside, and as long as we are in such an inflationary environment when it comes to the shortages and high prices of goods that are in still high demand, particularly gasoline, energy, food, shelter, right? So relatively modest wage gains. So in an environment where that doesn't show a whole lot of sign of abating quite yet, a 3.2% yield is still essentially a very negative real yield. So, a move up to 6, I think is entirely possible. And what happens from there, we'll see. We'll see what the charts tell us at that time. So, thank you if you made it this far, and good luck out there. And we'll reconvene in the next video. Take care.